All right. Good morning. Good morning to everyone. Thank you for joining, spending time with us, Lines of Angels, for our webinar. We're going to be talking about what you don't know about selling your company can hurt you. And we are privileged to have Loa Rickliffs, to one of the members of the Alliance of Angels, to share his wisdom, analysis with us today. Before we go in though, I want to mention a few things. First, if you are not speaking, we do ask that you place yourself on mute, right? So we want to have a great learning experience for everyone. So less like background noise, random background noise from various folks in the audience would be appreciated. But that's it too. If you have any questions for Loa along the way, you have something you want to ask, feel free to jump in, right? This is a regular Zoom call, so anyone can speak, anyone can share video, right? If you want to like come in and ask something, feel free to do that. So we can also have an interactive experience versus like a more of a one-way delivery lecture. All right, so with that, I'm going to share a little bit about my organization, Alliance of Angels. Right, this is it's an angel investing group here in Seattle. Every year we put about 10 million into 20 companies. There's about 140 angel investors in the group. I would say that most of the deals that we invest in, the total round size is somewhere between $500,000 to 1.5. And the typical round size, money from us, tends to be in the range of 250 to 500. But when investments come in from us, it's usually in the form of 4 to 6 people, each person putting in 25,000, 50,000, or 100,000. And the sum total of that is 250K to 500, right? So we're not a fund, like a Madrona, but we're a group of individuals, right? We look at companies together. By the end of the day, everyone invests their own money. They make their own investment decision. Their names go directly onto your cap table. You're an entrepreneur. Right, sector-wise, we're about a half IT, a quarter consumer. The rest is life sciences, hardware, energy, etc. That's it. We are a sector-agnostic investor, also stage-agnostic. Right, so if I'll say our only hard filters that we focus on companies that are headquartered in the Pacific Northwest. So if you're an entrepreneur, you're listening today and you're interested in approaching us for fundraising, feel free to send me a note. You can see my emails on this slide. Feel free to follow up, or you can also text me during the session. And if you are an investor that's joining us today, welcome. And if you're curious to learn more about membership in the organization, feel free to send me a note too. All right, so I'm going to stop talking and move over to the main event. I'm going to hand the session over to Loa. He's going to share a little bit about himself and his firm and the session that he's going to share with us today. Go for it, Loa.
Thanks, Eugene. Appreciate the opportunity to be here today. Is my screen being shared properly?
Looks great.
Okay, all right. So what I find is that people spend a lot of time building their company and don't always take the time that they could to get the most value for it. The best analogy is when you sell your house, it's pretty easy to paint it and clean up the yard and you'll get more for it. You don't just throw it on the market, the shape that it's in today. So I'll share with you, and part of my perspective comes from, my background is electrical engineer, computer science, sales engineer at Rockwell Automation, eventually vice president, global vice president. And so I had a lot of experience on the acquisition side, acquiring companies, was CEO of a publicly traded company that was acquired, CRO of another startup, and then founder, CEO, actually had some Angel Alliance investors in my company. And so this just really stems from what I've observed as a part of acquiring about a dozen companies. And now the past 5 years, having about 1,000 conversations a year with acquirers, I know what they'll pay for. And many of the things that they will pay for are things that you can change. My call literally that I just got off 5 minutes ago was with the CEO of a company valued at approximately 100 million. And he's taken a 6 to 9 month approach. Our conversation was around some of the things that they can do, the specific KPIs that they need to fine tune because they know that will drive the valuation and the bidding process. So that's what I'll talk about today. I'm also going to talk a little bit about who some of the buyers are. So I'll talk about some of the things, I'll close with the metrics that drive valuation and some ideas around how you can change those. In between, I'll talk a little bit about, I think it's important to know who the buyers are and why they buy. and how they operate. I think knowing structurally who they are and how they operate is helpful when you're building a company and you're having conversations with them, just so you know how they're wired and what motivates them. Okay, so most people have heard about, you've got strategic buyers and financial. So I'll talk about both of those. Strategic buyer is, they're an operating entity, just like you. They've got clients, they've got sales, they've got marketing, they've got quotas. They're running a real business. They've got tons of employees, and the biggest SaaS companies are listed on here. I actually just pulled this out yesterday. It was kind of interesting. So, Adobe, Salesforce, Intuit, ServiceNow, but there are hundreds, there are thousands of SaaS companies, and the surprising number of $200 to $300 million ARR SaaS companies that are acquiring as well. Financial buyers are an interesting category that don't always have a great name, but in the SaaS area in particular, I think they should. They know how to make money. So they're putting money to work. It's an investment vehicle where they allocate capital. They want to raise money. So I'll talk about the different types. You hear about the classic PE fund firm, but there are also search funds, family offices, and of course, venture capital. So let's talk about financial buyers. And I think this is helpful. At its simplest, many people remember Enron. Enron did some things badly. Congress put some things in place to prevent that from happening again, called Sarbanes-Oxley. And it all made sense. I'm not judging that, but it did add about a cost of, you could argue, plus or minus $1 million per year in the cost to go public, which means for smaller companies, they can't afford to go public. So in step private equity in 2002. And in the first 10 years in particular, they had 40% internal rates of return. So that's a $100 million fund turned into 1.6 billion. And that 1.6 billion would be pumped back into the market. So they did extremely well for multiple reasons. Part of it is they typically had like a 5-year operating plan. They didn't have to worry about quarterly returns. Just to put in perspective, there's $4.5 trillion in private equity. The New York Stock Exchange is 22 trillion. So it's like 20% of the size of the stock market. It's massive. And it's effectively taken over the lower end of what used to be the publicly traded stock market. Further perspective, it would be the 4th largest GDP in the world, just the assets under management. So it's hard to it's so like the speed of light. It's just so big, it's hard to comprehend how large it is. So just a little bit about how private equity works. They'll create a fund. They'll go to investors, LPs, and they'll raise money, and they'll build a fund, and they charge fees, management fee, and then they charge carried interest, so they get a percentage of the increase in the value of the fund. And they'll go out and they'll buy companies. And I'll talk more about who they buy and why they buy and where it fits. And then they're typically leveraged buyouts. So they'll usually raise debt as well. So they'll borrow money to buy these companies. I'll talk about why that matters as well in a minute. So here's a classic fund strategy: is they'll come up with a thesis or a strategy. This is a real example. COVID really drove logistics optimization for small and mid-sized e-commerce companies, right? They were now packing and shipping things that they used to sell off their shelves, and they weren't able to compete with the Walmart and Amazon. So in comes software to make them more efficient, to kind of optimize that for them. And initially they're looking for a platform, which is a foundation. So it's not a software platform, it's a company as a platform, typically with more than 10 million in revenue. But then what their goal will be to double or quadruple its size through organic growth. Simplest way to think about it, they'll want to double it with organic growth, and they'll want to double it with add-ons, so non-organic. So let's say they spend, $10 million company, say they spend 100 million for the platform, they'll allocate another 100 million for add-ons. So, 3, 4, 5, 7 million ARR companies, and then they'll invest in sales and marketing to double that. 10 plus 10 is 20 million in revenue. They'll double that to 40 million. They'll pay down debt, and they'll make a big return. So they're very, very, very good at making money on money. So platform fits the strategy. What is an add-on or a tuck-in or bolt-on? Those are the terms that get used. Well, it might be geographic expansion of the same product. So it could be branching into Europe or into Asia. Could be a product extension. Seattle company 10,000 feet was bought by Smartsheet a couple of years ago, and that was a product extension for Smartsheet, super logical. It could be a different product, the same client base. They may sell to SMBs. They have 100,000 SMBs in the US, and you've got a product, you've got 1,000 clients. They could buy it and just roll it out to the same client base. Cross-selling and upselling. So they like your installed base. They want to sell their products into your clients and sell your products into their clients. It could be a competitor, so it's a market share focused play. So they eliminate a competitor and they increase their market share. And it could be a desirable customer base. Perhaps you've got a large, client that's very desirable. Maybe you do business with Amazon or a large government institution. It could be synergy costs. Less so. The traditional private equity got a bad name for synergy, right? Where they buy a company, strip out the costs, right? That's where they really got a bad name. They don't typically do that. That's not the model. Like usually they're looking at for how much capital they want to put on the balance sheet to increase things and accelerate the speed. This for SaaS-based private equity. I won't spend a lot of time on this. This is really just to show number of IPOs, and this is a year old, but IPOs on the bottom, whether 100 IPOs versus 600. So they're like 6 times more companies exiting to private equity than exiting on the public markets. So it's far more common. And you could argue the tech IPOs this past year, or a year ago, actually haven't done well lately, just as a class. So another thing I'll throw out there, a lot of the CEOs I speak with tell me, I hear from PE funds all the time. They're really interested in my business. Well, let me tell you, there are 2 primary reasons, and then there's a third truth of why they're reaching out to you. I think it's important to know. They're usually a couple different categories. One is, a junior associate, a new hire. Their job is they're basically marketing people. And their job is, they're dialing for dollars. So they've got a list of, 2,000 software companies, and they're reaching out to 20 a day, trying to get calls and then load up their database. So they don't have a specific reason. They'll make you feel like there's a reason, but it's usually pretty generic, and they're just trying to learn information, get to know you. So, if there's a fit, or in the future there's a fit, there's like established contact, but they're building their database. The second is a little bit more credible, where they have an active strategy and a thesis, and they're doing what they call a buy-side process, and they're reaching out to companies that they think would be a good fit for that thesis. Those are better. Those are usually they've done their homework, they put some effort into it, and they're legitimately probably interested. But the other thing, number 3, I think is important, is again, the things that can hurt you, they're trying to avoid a process. They're trying to avoid you hiring someone, that does what I do now, which is to run a process, get multiple buyers, and drive the price up. Their goal is they find out there's a fit, and they offer you something that's attractive, and they don't have to compete with other people. Because remember, their goal is to make money. And if they can buy low and sell high, they make more money than if they have to pay a premium and then grow it even more. So another class of private equity are search funds, which is really, really interesting because it's just starting to move into SaaS. And if you don't know what it is, it kind of grew out of Stanford, where people would take someone that's gotten their MBA at Stanford and has gotten very technical education on how to analyze a market and identify good targets. They said, well, let's hire one of those people that's really good at that. We'll pay them for up to 2 years to find a good company to operate. And when they find the right company, we're going to plug them in as the CEO. We're going to put some money on the balance sheet, and we're going to grow it. And it's done really well. CES analysis of 400 search funds last year showed that average IRR of 32.6%, which is absolutely phenomenal. So there were 51 new funds last year, and more focused on SaaS. They used to be more, plumbing businesses and things less exciting than SaaS. But now there are quite a few that are very focused on SaaS, and We actually did at least one deal last year. We're working on another right now. It's a search fund. So oftentimes a search fund can be a good fit. Family office, many of you are familiar with, locally there's Keeler Investments and East Seattle Partners. Another one is Graham. You see those 6 pictures on the bottom. Those are 6 different strategies they've got. It's a multi-billion-dollar family office, but it is private equity, but instead of having limited partners that invest into a fund in order to get a return, it's one family, and it's a portion of that family's assets that they want to invest in growing for themselves and the future generations. One of the things that can be different about that, it tends to be more personal because there's a single family attached to it. Often they'll buy and hold for long periods of time. And just very generally speaking, they tend to be fairly thoughtful in the way that they deploy money. It's just more personal. They're buy and hold companies. So the biggest of which is Constellation Software. It's got a $29 billion market cap, but their goal is not to buy and fix it up and resell it, but their goal is to buy it, generate cash flow for as long as possible, and then use that cash flow to buy other companies. They tend to be value buyers. They tend to be low multiple buyers, but in the 1 to 2 to 3 times revenue. But for some people, it's a good fit for multiple different reasons. So let's talk about strategics. A strategic buyer, acquires another company in the same industry. They want to capture some kind of synergies. So usually they're looking for more revenue, right? They want to scale it up more quickly. And I talked about it a little bit earlier, but if a strategic buyer, part of the reason strategic buyers can at times pay a premium is if they've got a large installed base and you've got a small number of clients. Think about private equity. They're going to buy you and operate you. So they have to grow organically unless they buy other companies to add on to it. A strategic can simply take your product and roll it out to all of their clients. And even if 10% of their clients buy it, it could double, triple, quadruple the value or the revenue of your company. So they're looking at your company at their scale, not just at your own. So that's why there's interest there. I talked about this a little bit earlier, but they're looking for geographic expansion. UK company looking to get the US, product extension. So there's missing functionality, same client base, buyer profile, cross-selling, upselling. I think I covered this before. And one of the things to look for is, do they have corp dev or not? Right? When we reach out, if they've got corp dev, it means they've paid someone, usually paid fairly well, specifically to non-organically grow the company. So they've got a professional in place to buy the company. If they don't have corp dev in there, they might still be interested in acquiring, but it means it's not a core part of their strategy. At least they haven't invested in that as a core part of their strategy to hire someone to do that. Financials. So often publicly traded, so they've got to get it right. So you want to get your financials in order. Often small SaaS companies work on cash. It's better for tax reasons. At some point, they're going to want to look at accrual financing. And typically before they get to a purchase order, they're going to require a QOV, a quality of earnings. It's a little bit of an audit, but they'll create their own version of accrual finances. One of the things that crops up a lot there, this is something to be aware of. If you effectively self-finance with prepaid revenue, which is very, very smart, highly recommend that if you're a fast-growing company. So get prepaid contracts. They will look at the unearned revenue on those as a liability. So that will be a deduction from the sales price. So just be eyes wide open. So if you're doing $5 million a year in revenue and you've got $1 million in cash, but you've also got a year of prepaid contracts that you've already collected on and haven't executed on those, just be aware. That's an eye opener. For some people, when they get to the end, they realize that that's considered a liability. The technology, are they compatible tech stacks? Do you have tech debt? That's one thing to look at, one thing to be aware of. If you've got a 15-year-old tech stack, monolithic tech stack, and the buyer, or some buyers anyway, start to say, well, if we've got to rebuild it anyway, why don't we just build our own? So keeping the tech stack current will make it more valuable. Product, often it's a competitor that you're working with, which can make it delicate. They'll want to go deep into the product and the roadmap. So, figuring out how to do that tap dance with a competitor can be interesting. Customers that want to go deep on who the buyer is, who the user is, where the customer concentration is, and then how sticky is it. Go-to-market strategy, how do you sell? Sales and marketing. Pipeline, they want to look at your backlog. They want to make sure that the backlog justifies the revenue forecast that you've got in place. So it's worthwhile taking time to make sure that your pipeline is clean, certainly that it's fairly accurate, and often it's at different states. You want to clean that up. And then we talked about cross-selling opportunities. So, sometimes they'll want you to, as a part of the diligence, to pitch to some of their clients and get a feel for whether their clients actually see it's a fit before they buy it. And then this is kind of interesting. What you may find is that many, if not most, of the potential buyers are a strategic. So it's a real company, but they've got a financial sponsor. So this is one we ran across a couple of years ago. There was a potential buyer, a company called Arcos, and they were owned by a private equity firm called Riverside. This is quite common. And the reason it's common is the most acquisitive strategics are the ones that have a private equity sponsor. It's just what they do. It's in their DNA. So 7 things to know. So number 1, SaaS valuation, EBITDA or ARR. So the short thing to know here, EBITDA buyers are going to buy on multiples of EBITDA. ARR buyers are going to buy on multiples of ARR. The multiple is about the same. So if someone's going to pay 6x on your company, you want them paying 6x of revenue, not 6x of earnings. It's clearly a completely different number. So you want to be careful of buyers that are EBITDA buyers, or if the parent company is valued on multiples of EBITDA, often they'll struggle to pay multiples of ARR. Valuation drivers. So, size. So obviously the value is higher, but the multiples are higher when you go from, less than $1 million, it's difficult to sell. Over 5 million, you become interesting to companies looking for add-ons, actually in the even, $3, $4, $5 million range. 10 million or more, you can be a platform. More than 100 million, it's higher. There aren't that many growing SaaS companies with that much revenue. Growth. If it's flat, that's okay. 10 to 20% is better. And then greater than 40% puts you in kind of a unique category that makes you very interesting, and the multiples get quite a bit higher. If the growth is declining, it's difficult to sell. Private equity firm once told me no one wants to catch a falling knife. A little graphic, but it can be done. It makes it much more difficult. Are you burning cash? You don't have to be profitable, but being break even or better helps. Companies don't want to invest more into a company that they buy. Lots of anecdotal information out there of very valuable companies burning a lot of cash that get bought, but the vast majority of deals are break even or better. Customer concentration. If you've got 30, 40, 50% or more with a single client, that will be a detractor to some of the buyers. Logo churn. This is a big deal. If you're SMB, normal churn is higher. Mid-market, the norm is lower. Enterprise logo churn tends to be pretty low. So kind of where do you fit in those categories? Net revenue retention is another one, similar to logo churn, but really measures your ability to upsell. The way to think about it is if your net revenue retention is 100%, it means without selling anything, your revenue stays the same, that your upsell to existing clients, offsell clients that lose. If you're over 100%, makes it quite interesting. If you're over 120%, makes the multipliers quite a bit higher. TAM, you all know about TAM, but your specific product area TAM. If it's 100 million, it looks more like a point solution. It's got limited market. Interested buyers oftentimes, but it's a smaller market. If it's over $1 billion, quite a bit over $1 billion, it's effectively unlimited, and the multipliers can be higher. So size thresholds, actually I just talked about that a bit on the previous slide. So obviously bigger is better. The key is if you get to 2, good chance someone will buy the company. You get over 5, you'll have multiple people. You get over 10, and you'll have quite a few. So a little bit more on declining. Talked about that. Logo churn, I got just a little bit more detail here. If anyone wants to see this, this is what's used to measure the logo churn. And then the net revenue retention, is critical. And again, you can see that for SMB, 90% is pretty good. For enterprise, net retention 125% is considered quite good.
The insurance for the year, since your insurance renews in April, right? Your insurance renews in April.
Yeah.
And you're maxed out right now.
Okay.
So what we've done
Can we
today
mute
is
that?
looking at this.
Okay. So, all right.
I didn't get what logo churn
Sorry?
is. Can you just quickly explain what is logo churn?
Yeah. I should stop to let people ask questions. Logo churn is really, you take January 1, or take any 12-month period. If you've got 100 logos January 1, you can't count any new logos, but a year later, of that 100 logos you had on January 1, a year later, how many are still there? If you've got 95, then your retention rate is 95%.
Sorry, so how do you get to 125%?
That's on the net revenue retention. So net revenue retention is measured. You take that same cohort on January 1, and then you can't add any new clients, but what is the ARR of that cohort 1 year later? The short story is the only way to get there is you have to upsell. So ideally you can sell them additional modules, but you've got ways of it could be a per seat license. You sell to the University of Washington, you get the medical group 1 year, and then they expand into the broader education group. It goes from 10,000 seats to 50,000 seats. So your revenue goes up for the same logos. Does that make sense?
Yes, thank you.
Okay, sure. I've got the formula in here too. If you want to, it takes a little bit to get your head wrapped around it, but it's a measure of how valuable is that revenue stream. At the end of the day, buyers want growth and they want retention. That's why they pay huge multiples for recurring revenue businesses. If your churn is 50% annually, it means you'll have all new clients. Well, in 2 years. It's not really recurring revenue. It's just a 2-year license. So those get traded lower. So they're looking for the measure of growth and then a measure of the retention of that revenue stream. Net retention is a big predictor of growth. SAS Capital ran this, and they showed that companies of the cohort growth rates based on net retention in the 80 to 90%, they grew 23% IRR. Well, I guess revenue growth, and those over 120% grew almost 60% per year. So this is kind of what's behind it. It's a predictor of success. I won't go through this. It's a bit of an eye chart, but if people want to look at that, if you've got a company, if you want to see where you fit, it shows it's a range of churn by your target client base. Total addressable market. Again, I spent a fair amount of time on the previous bullets. Rule of 40. This is like a baseball term, right? Where you add two different percentages together that are unrelated and come up with a number that shouldn't make sense, but it does. Private equity is big on rule of 40. So if your growth percentage plus EBITDA percentage is over 40%, there are certain, I call them the 10x plus companies take notice. They tend to, it perks their ears up. So if you're growing 20% and you're 20% profitable, you're at the rule of 40. If your growth is 0, but you're 40% profitable, they're interested. If you're 40% growth and even, they're interested.
Is that when you say profit, is that gross profit margin, net profit? What are they looking at there?
Yeah, no, good point. They tend to look at EBITDA.
Thank you.
Yep. I got some questions. Are larger TAMs considered too good to be true? It depends. So the question is, are larger TAMs considered too good to be true? It depends. At the end of the day, it's like trust but validate. So whatever you promote, it needs to be backed up. If sometimes it's difficult to get really good data that's granular for what your particular solution is, but you can kind of do a bottoms up approach and say, well, we think there are 50,000 people that do this role and we charge $1,000 a license. So it's $50 million market. And you can do top down and you can find some industry data and say, oh, this is a $3 billion industry overall. And we think 10% of that is our market share. You can kind of take some swags at it from the top and the bottom and get relatively close. But strategics that know your domain often won't look at the TAM analysis as much because they just kind of know. They're in it and they know. But private equity, often they're learning. Like, you're the domain expert. They're often not. They may pull in some experts. So they will often hire some industry experts to do an analysis of the TAM. And what you don't want to do is pick a buyer, go to LOI, spend months and money, and then find out once they do the market analysis that the market isn't as big as you said it was, because then they'll back out or reduce the price, and then you'll be forced to start over. So it is helpful to have it figured out fairly closely initially, and too good to be true. Yeah, you don't want to just pull a giant number out there. So, yeah. All right, let me. Okay, so does Rule of 40 hardware-enabled SaaS? So, like, interesting. I will tell you that I have seen SaaS and non-SaaS companies mixed together, so license revenue. I can't give you a very good answer on hardware-enabled SaaS. I don't have much experience there. I can tell you that if there's a mix of SaaS and non-SaaS, so it's like purchase products, so whether it's a license or other, they usually value it on multiples of the SaaS. They almost ignore the non-SaaS business. So it's not like they say, well, give me a 3x on the license and 10x on the SaaS. They'll typically give you close to 0 on the non-SaaS, which doesn't always seem like it makes sense. But if you've got a license-based model, it is absolutely in your interest to migrate that to SaaS, even if it's painful with your clients, because you will get multiples on that. And they'll look at it as a headache that they don't want. Not only do they not value it, they could actually look at it as detrimental to the business. So quick summary: regional expansion, product gaps, different products to different client bases, pay more, they can justify more with a cross-sell. With strategics, there's often less certainty. The process can be more complicated. Financial buyers, the certainty tends to be higher. Like, their goal is to buy companies. They don't, so that's just what they do. Let's see. Okay, so kind of in summary, buyers aren't as simple as strategic or financial. Often you're going to get a bit of both, and that's actually good. It's not bad. People shouldn't be afraid of it. There's some really high quality people out there and good companies with a lot of money. And to get high multiples, they want growth and retention. So that's really what sticks. And take the time, 6 months, a year, and look at your business. There are things you can do, like like the paint your house analogy. We talked about net retention. If you increase your prices, often people haven't raised their prices in years. If you raise the prices by 5%, it'll bump your net retention by 5%. If it goes from 90 to 95 or 95 to 100, that's a big deal. I mean, that could be the difference between a 5 and a 6 on a multiple. There are things on the logo retention. When you're building a company, you want to sign up everyone you can. If they leave, I mean, you want them to stay, but if they leave, you don't really, it doesn't matter, right? You don't care about the metrics. You just want them to stay. But it does matter when you're selling the company. So if someone is on a pilot or a trial, if they haven't truly signed a long-term subscription, they shouldn't be counted in your long-term metrics. So there are a lot of little tips and tricks and things that you want to get in order. There's some back office things. IP assignment, this comes up quite a bit, right? When it's 3 of you on a napkin trying to build a business, I mean, who cares about IP assignment, right? You're just taking an idea, try to bring it to life. A buyer cares, right? If the person that helped you write the original code left the company, may or may not be on good speaking terms, and didn't sign an IP assignment, that can be an awkward conversation to have later on. So try to get that stuff done sooner than later. Try to get your financials in order. If you've had a part-time bookkeeper that maybe didn't get everything into QuickBooks, it's a big deal. Try to get that cleaned up. If you can do accrual, it does make some things easier. There's a little bit less guesswork, a little bit less risk when you get close to the end. And then, a lot of the understanding is just the different types of buyers that are out there. There are far more potential buyers out there than I ever knew when I was in an operating role. I had kind of the usual suspects on a list, but really didn't realize that there were other companies out there that sold the same customer base that I didn't really pay attention to. And they weren't much bigger than we were, but they were just bought by a private equity firm that has an aggressive strategy to create a massive platform. And because we sell to the same buyer, they would roll us up. Okay, I am going to stop talking. And any questions?
You can put questions in the chat window as well if you'd rather not speak up.
Yeah, I have one that might be a little too direct, but I didn't know there were M&A advising companies out there. So this is new and exciting to me. What's the normal kind of cost basis for engagements on M&A advising?
It's kind of across the board. It depends on the size of the company. It depends on who you engage with. I could probably talk to you. And I don't want to speak for others that are out there, but typically there's a retainer, like a monthly retainer, and then there's a success fee on the back end.
Awesome.
It's usually a percentage, and then often there's a minimum. The bigger banks that you know of in town have pretty significant 7-figure minimums. There are brokers that are out there, small businesses. There are sites like Biz Buy Sell. You can get brokers that are commission only, but you often get what you pay for. So yeah, but happy to chat in more depth on that.
Excellent. Thank you. I appreciate that.
Yeah. And I'd say, and just generally speaking, I'd say below 2 or 3 million, it's probably pretty expensive to hire an advisor, a banker. It's hard to make it work. I often just give free advice for people that can't afford to run a process, but above 4 or 5 million, it really does pay to have, you're working with professional buyers. It can be a very expensive lesson to learn how to sell your company when someone else knows. There's just a lot, just things like networking capital targets at close is a confusing thing, or negotiating, if you've got unearned income. There's just a lot of different things that come along. I could probably do another talk on all those things. I don't want to spend too much time, but things like negotiate your non-compete. It's awkward for you to negotiate a non-compete with the guy that you're going to work for. You say you want to stick around for 5 years, but then you want to really narrow non-compete. Retention bonuses, just anything that's tough. You're going to be working for them. It's nice for you to come out clean, and you can let someone else be the bad person. Ask the tough questions.
You said it would be another talk. I would attend that one.
Okay.
If
Happy
you're
to.
interested.
Yeah. Well, it's good to know. It's a stressful process. I really say, I called earlier today with someone who had sold a company earlier, and you've either sold a company or you haven't. And I can talk about it all day long, but until you go through it, actually, I'd be happy to do that. I could bring on 1 or 2 previous clients too. Actually, they could talk about the experience from their perspective. What was stressful, what worked well, what they wish they'd known. That's a good idea. All right. A question: how would this be different for a non-SaaS company, consumer products? It's a good question. I've done a couple non-SaaS businesses. The process is still fairly similar. The negotiation is still fairly similar. The valuation is different. If it's consumer products, you've got things, you've probably got inventory, you may have work in process, and you've got assets, right? I think that's the biggest thing that makes it different. So you've got to put a value on a lot of those things as well. So you've got a few more, I don't know if it's more moving parts, but certainly different. SaaS companies tend to be financially simple. I mean, relatively simple, but yeah, I'd say that's probably the biggest difference. Yeah, services company, I've talked to consulting companies before. Multiples tend to be different. Often it depends on the services company, but services companies that have the fear of buyers I've seen, and this is, I won't call myself an expert on these. I know enough to be dangerous, so to take that into consideration. One of the concerns buyers have is often the principal at a services company is really the key to the relationships that drive the business. So if you're going to stick around, then it makes it more valuable. But their concern is always that the principal is selling the companies, that they don't stick around. If they don't stick around, how long will that business land? So, but they'll look at the quality of your client base, and services companies get bought all the time. They roll up the talent and they roll up your client relationships, is my impression of. And you do have services companies, they may not have contractually reoccurring business, but they do have reoccurring business that, I know my attorney that I've worked with for, I don't know, 5-6 years, right? So I'll probably work with them next year. So it is repeatable. It's just not contractual.
That's what I've seen as well. If that's what you just said is borne out to be the case. We have clients come back year after year. Sometimes they'll take a year off and then come back after that. So absolutely.
Yeah. I mean, so it'd be dangerous for me to say this, but I mean, what I have seen and it's often based on revenue and a lot and contract size and a lot of different things. But I think a reasonable range for services companies that I see is in the 1 to 2x top line revenue range. Is what I have seen. But I don't talk to thousands of service company buyers like I do SaaS companies. SaaS companies, I'm very grounded. I've talked to enough that I am extremely confident. I know what they will pay. I have an idea from doing some research for some clients on what services companies will pay.
Great, thank you.
You're welcome. Anything else? There are no dumb questions. You can ask anything.
There's a question in the chat actually about researching what a reasonable multiple would be.
You're right. I read that wrong. So for a consulting company, I mean, honestly, Google is a great place to research. You'll find a number of different articles that come up. If you literally just research, typical valuations, typical acquisition valuation for cybersecurity consulting. Yeah, I've got I would take a look at that. You could look in Crunchbase. If you've got Crunchbase Pro, you could probably get a little bit more. PitchBook is pretty expensive. You can do a fair amount of research in those tools, but I think on Google, you could probably find you can just Google some reports that'll give you a pretty good idea on how these things get valued. And if you struggle to find something, I mean, just shoot me an email or give me a call. I can try to find some information for you. That's a good question. Okay, so the question is, what if you're selling the IP and code alone? It can certainly be done. If there's no revenue with it, it makes it harder. Buyers will spend, at least a couple $100,000 just doing a deal. Usually they'll buy a company for the product, for the employees, and the revenue. So if they're just getting the tech, they're not getting the employees and the revenue, it makes it harder. It's hard to nail it down. I mean, it's a more open-ended discussion. You can start with things like, well, well, how much did it cost you to build it? Or how much would it cost them to build it? You know, and what's the value of the time it would take? If it takes them 2 years and $1 million to build it, what's the value of having it today instead of spending 2 years? Is it worth $1 million? Is it worth 2 million? It's more of an open discussion, but it's more of an artistic discussion. It's how badly does someone want it or need it? You know, and if it's IP, if it's protected, if they truly can't build it because it's protected, then it's more valuable. I do see sometimes in those cases too, it may be more of a royalty stream where they'll buy it and you'll get a royalty for 5 or 10 years for the usage of it, as opposed to cash at close. But it's just more wide open. Range of valuations for SaaS. So it's all over the board, but the range is from call it on the low end to, you know, so we work with companies with 5 to 20 million in ARR. So enterprise value, you know, on the low end, it's 10 million. And on the high end, you know, it's in the 1 to 200 million. And the vast majority are in the 4 to 7 times revenue. Because these are, and part of the reason why is companies in that range, if they're growing at 100% per year, they're just not going to sell. So we have companies that tend to be, you know, in the middle. So they've got good growth, you know, 20, 30, 40, 50% growth. They've got decent margins. You know, they're good companies. They're very good companies, but they're not the hockey stick growth companies, right? They're not headed to be the next unicorn. Those that are, if they sell, can command, you know, 10, 15, 20. And we do have a portfolio of buyers that are interested. If you hit that rule of 40, they'll pay 8, 9, 10. I say all day long, but if it's a fit for their platform, if you've got 120% net retention, if you've got 100% growth, and you've got 10 million in ARR, you'll see 10 plus, likely to see 10 plus multiples. I'll say that with a caveat. It's interesting to me. I'm actually gonna start doing some research. Maybe I'll do another talk on it. Part of the reason multiples have been so high, the stock market's been high. Those multiples have filtered down to the private equity market. Interest rates have been near zero. As if you saw earlier, private equity borrows money. If you can borrow money at zero, your returns are higher. If you're having to pay for that money, I'm being facetious, but if you're having to pay more for that money, the returns are lower. So it's probably going to put some pressure on what the multiples have been over the last year or two. I don't see that yet. There's still just as much capital out there. It's just the debt is a little bit more expensive. PitchBook is fantastic for valuation.
Thanks to Meredith.
PitchBook is great. I've actually got PitchBook. Yeah, I would agree. Yeah, Meredith made a comment that PitchBook is an incredible tool, and it just continues to get better. So I'll give a big pitch for them. I'm a big fan. Sorry, Eugene.
No worries, no worries. It's just last call. Are there any more questions? Okay.
Good. Well, thanks everyone for your time. Yeah, I don't get to see everyone as well. I miss the in-person meetings where I can actually see people. Otherwise, I'm just talking to my screen. But anyway, I appreciate it. Thanks.
No, and thank you so much. It was great.
Yeah.
Appreciate it.
Thank you for your time. We appreciate it.
Thank you.
Thank you.
Yeah. Thanks everyone for joining as well. Have a great rest of the week. Thank you.